Hey everyone, welcome back to Corporate Decoder, the place where we decode the whispers of Wall Street to reveal the truth behind company filings. And let's just say Akari Therapeutics has a rather interesting plan to get funded. Akari Therapeutics just filed a Form 8K, and it's all about a new agreement that could bring them a lot of cash, but it comes with some pretty unique rules of the road. This filing essentially tells us how Akari plans to raise money through selling its shares to a specific buyer. We're talking about Akari Therapeutics. They're a biotech company currently trading on the Nasdaq under the ticker AKTX. They focus on developing new treatments for serious diseases. Now, the big news here is this ordinary share purchase agreement with a company called White Lion Capital. Think of it as a flexible funding deal. Akari can decide when they need cash to sell their ordinary shares to White Lion Capital. Up to how much money? A cool $25 million, but here's the twist. Akari doesn't have to sell, and White Lion has to buy if Akari decides to sell, provided certain conditions are met. What are those conditions? Well, Akari needs to make sure that the shares they want to sell can actually be resold to the public. This means they have to get a registration statement approved by the Securities and Exchange Commission, or SEC, and file a final prospectus. This whole process can take some time from the moment this agreement is signed, which was August 29, 2025. Akari has up until August 29, 2025. Akari has up until August 29, 2025 to tap into this funding. This is called a commitment period. During this time, Akari calls the shots on when and how much they sell, but how do they determine the price? This is where it gets really interesting. There are a few ways Akari can choose to sell. They can opt for what they call rapid purchase options. One option is to sell at the absolute lowest traded price of their shares on the day they decide to sell. Imagine the stock price dips really low that day. Akari could choose that lowest point. Another option involves selling at 97% of the lowest traded price during a specific 2-hour window after they notify White Lion. So if the stock price falls significantly within those 2 hours, Akari could potentially sell at a discount to that lower price. Then there's a third rapid purchase option that gives Akari even more flexibility, or perhaps a safety net. They can choose the lowest price among the opening price of the day, the closing price of the previous day, or the average price over the day. And as an extra kicker, there's a potential 20% discount if the stock price dips below the opening price on that particular day. Finally, there's the VWAP purchase option, where the price is tied to the volume-weighted average price over 2 days. For the first $12.5 million sold, they get 97% of that VWAP. And for anything to sell them a dollar, try and get the best possible price for their shares when they actually need to sell them. Now, there are some limits. Akari can't sell more than about 13 billion shares, which is roughly 20% of their outstanding shares. This is to prevent them from diluting existing shareholders too much without their say-so. However, they can sell more if they get approval from their shareholders, or if the average price they get is high enough. Also, they absolutely must follow Nasdaq's rules, which means they can't sell shares if it would mess up their listing status. And there's a cap on how much White Lion Capital can own at any one time without triggering additional disclosure requirements. They can't own more than 4.99% of Akari's shares unless they give 61 days notice to increase that limit to 9.999%. This is all about managing ownership and regulatory transparency. For taking on this commitment, White Lion Capital gets paid fees. There's a $15,000 fee for paperwork which comes out of the first sale of shares. Then there are cash commitment fees based on how much Akari has sold. If Akari doesn't sell at least $25,000 worth of shares within 180 days after the registration statement is effective, they'll issue additional shares to White Lion as a fee. Hand in hand with this purchase agreement, there's also a registration rights agreement. This means Akari has to file the necessary paperwork with the SEC to register these shares so White Lion can freely resell them. They have to file this within 30 days of signing the initial agreement, and they need to work hard to get it approved and keep it effective until all the shares are sold or the agreement ends. Beyond the funding news, there's a significant leadership change happening. The Chief Financial Officer, Torsten Hombeck, is stepping down on October 10th. He'll stick around as a consultant until at least the end of November to ensure a smooth handover. The company says his departure is for personal reasons and not due to any disagreements. Akari has already started looking for a replacement. This kind of departure, especially for a CFO, can sometimes signal shifts in strategy or financial outlook, though in this case they're emphasizing a smooth transition. Now let's shift gears and Think about what this deal means for Akari. This type of agreement, often called an equity line of credit or a flexible equity financing, is common for biotech companies that have promising drug candidates but aren't yet consistently profitable. Essentially, it's a way to secure funding as needed without the immediate pressure of a large one-time stock sale that could significantly dilute existing shareholders. The strategy here is to have a funding backstop. Akari can draw down on this line of credit when it makes sense for them, perhaps when they hit a key development milestone or when market conditions are favorable. The multiple pricing options are smart. They allow Akari to try and get a better price when the market is moving for them, hedging against the risk of selling too low. However, there are always risks with these agreements. The fact that they have to register the shares for resale means there will be ongoing disclosure. If the stock price performs poorly, selling shares even at a discount might feel like a significant dilution to current investors. The company's ability to manage this dilution while advancing its pipeline will be key. From a Warren Buffett perspective, you'd want to see how Akari is using this capital. Is it fueling genuine progress in their therapeutic pipeline? Are they reaching key clinical trial milestones? The valuation of biotech companies is heavily tied to the perceived success and future potential of their drug candidates. This funding provides runway, but the ultimate success hinges on scientific and clinical validation. The departure of the CFO, while stated as personal, is something to keep an eye on. A stable finance team is crucial for any company, especially one that relies on external funding and faces the complexities of drug development. The company is actively searching for a replacement, which is a positive sign that they're addressing the gap. In conclusion, Akari Therapeutics has secured a flexible funding facility that gives them financial breathing room to pursue their development goals. The various pricing options are a calculated approach to managing the cost of this capital. The success of this strategy will depend on Akari's ability to execute its development plans and manage shareholder dilution effectively, all while navigating the inherent uncertainties of the biotech industry. The CFO transition adds another layer of monitoring for investors. Alright, that's our breakdown of Akari Therapeutics' latest filing. What's your take on this funding deal and the leadership change at Akari? Do you think this is a smart move for the company? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and make sure you're subscribed for more deep dives into corporate filings. You can also join our Discord community linked in the description to chat more about these insights. Thanks for watching, and we'll see you next time on Corporate Decoder.